Over the past 8 years, I've read countless books on money, from stock market ideas like The Intelligent Investor to business strategy books like $100 Million Leads, which is easily the biggest book on this list, all the way to understanding how societies and economies collapse. So today I'll be sharing the #1 lesson from each of my top 30 books that helped me build my $300,000 portfolio. And I've broken it up into themes from investing to mindset all the way to big picture, so you can skip around to the parts that you like the best. Starting in the investing section, we're going to kick it off strong with the best investing book pretty much of all time, which is The Intelligent Investor, written by Ben Graham in 1949. This is widely considered as the foundational text for value investing, advocating for long-term strategies and rational decision-making in the stock market. Now, chapter 8 and chapter 20 are likely to be the most beneficial chapters if you're going to pick up this book. And I say that knowing how value-packed this book is with everything that Ben Graham put in there for us. But for the broader audience, and if you're just trying to learn some general principles to follow for investing, these 2 chapters are going to be key for you. The first one is the concept of Mr. Market. Now, Graham describes the stock market as an irrational person whose only job it is to price stocks. But because he behaves irrationally at times, this gives you some advantages to buy when stocks are lower than they are actually worth. And it's up to you to determine if the price is a good value to buy or not. And I love this quote in particular: "You do not have to trade with him just because he constantly begs you to." This is of course referring to all the price changes that we see every single second of every day for every stock that exists. The second one is the idea of margin of safety. If you're going to buy an investment, make sure you always have a margin of safety to protect you from the downside when stocks decline. In other words, don't buy at its peak price, buy it below intrinsic value, which is one of Graham's timeless principles, but it's also easier said than done, so just keep that in mind. We'll follow up The Intelligent Investor with Unshakable by Tony Robbins, which was written in 2017. And this book can kind of be boiled down to 2 main principles that Tony Robbins talks about. Invest in index funds with low fees, and do it in ideally a tax advantage account like a Roth IRA, for example. That's it. This is my #1 book for all beginners because it's very clear and concise and a pretty easy read. So if you wanted to go from a complete beginner, ground zero with understanding investing, to actually feeling confident with starting your investment journey, I tell everybody to read this book first, because that's exactly what happened to me with this book, so I share it with everybody else who's starting their journey. One Up on Wall Street was written by Peter Lynch in 1989, and the main theme is to guide investors on how they can use their everyday knowledge to beat fund managers. Now, this is one of the few books in this list that doesn't have a single main takeaway, because really the whole thing is packed with incredible value. Instead, I view this book as acting like a stepping stone to become a better investor. So if you started with Unshakable, for example, and you wanted to learn more about the stock market, learn how to maybe try to pick your own stocks and see if it's worth doing, then this is the book I recommend, because it's going to help take you from beginner to intermediate in terms of understanding what to look for when you're looking to pick stocks and buy companies. Now, for the sake of listing a specific lesson for each book, page 110 is a really good place to start to see how Lynch categorizes different companies. The 6 categories are slow growers, stalwarts, fast growers, cyclicals, asset plays, and turnarounds. And Lynch says that putting stocks into categories is the first step in developing a story. Now at least you know what kind of story it's supposed to be. The next step is filling in the details that will help you guess how the story is going to turn out. And one of those details is understanding where the money is. Now, this book was written by Adam Cecil in 2022, and it's essentially a modern version of Warren Buffett's principles for today. Ben Graham in The Intelligent Investor started us off with Value 1.0, then Warren Buffett gave us Value 2.0, Adam Cecil is here to give us Value 3.0. The main takeaway from this book is what Cecil refers to as the Value 3.0 framework. And it's essentially describing how accounting standards have not been updated as businesses have evolved over time. For example, the author argues that all the big tech companies we see that are priced at a really high PE ratio are not quite as expensive as they may seem at first. And a simple illustration of this is in chapter 7 on page 129, comparing an old industrial company versus a new technology company. So if they both have revenues of $100 million, and they both invested in infrastructure that fits their company, the industrial company gets to spread out that expense over the next 25 years. And so it looks like their operating income is 96 million, whereas the tech company has to write off the entire thing in a single year. So it looks like their operating income is 0. And that's just the way that accounting works right now, even though they're essentially the same thing. And this is just one example, but there are thousands of companies today that have the same kind of problem. And it's one of the reasons why traditional metrics like a PE ratio can make things look too expensive when in reality, that's not exactly the case. And Amazon is a perfect depiction of this. They invested so much money into research and development for years, which made them look unprofitable and way too expensive. And yet, if you bought them 25 years ago and held until today, you'd be pretty rich. So the next time you hear that a company has an amazing business, incredible sales, really good profits, it might be worth digging a little bit more to see for yourself if that's true. 100 Baggers was written by Christopher Mayer in 2015, and this is one of my favorite books on this entire list. And the reason being is because the entire idea behind the book is to identify patterns for stocks that can potentially earn you 100 times your money. So if you started with $10,000 and you hit a 100 bagger, you'd have $1 million from a single investment. But the number one takeaway that I got from this book is that in order to get a 100 bagger at some point in your life, you'll most likely endure a very steep decline, probably more than once, and it's going to make you question everything that you did with this investment. Now, take Apple, for example. If you bought Apple in 1980 and held through 2012, you would have a 225 bagger, but you would have seen your money drop by 80% twice, and there were multiple 40% drops along the way. Netflix is another great example, which has been an 80 bagger since 2002. It's lost 25% of its value in a single day 4 times. On its worst day, it fell 41%, and over the course of a 4-month stretch, it dropped 80%. We saw it drop again by 74% in 2021 and 2022. So the point is, if you want to make huge gains in the stock market, you will have to endure some pain along the way. Also, if you're curious like I was about the list of all 100 baggers since 1962, which honestly has some companies that I never would expect it to be on there, you can download that in the link below for free. The Most Important Thing was written by Howard Marks in 2011. In this book, he discusses the principles for successful investing, and he really focuses on risk management, which I understand may not be the sexiest topic in the world, but I promise it's going to be incredibly valuable. So after reading this book, Uncle Howard became one of my favorite investors of all time, because he is so incredible at clearly explaining his logic and reason for all the decisions that he makes. And his track record is one that rivals Warren Buffett's, and Warren Buffett also admits to reading Howard Marks' memos every time he writes them. So the number one lesson that I've learned from Howard Marks is understanding the 2 main types of risk. The first is the risk of losing money, and the second is the risk of missing opportunity. Now, the first one is more obvious and more painful, but I think the second one is more important because it's less obvious. Let me explain. So a good investor must try to strike the balance between making money and not losing the money that they already have, which in my opinion is the most exciting part about all of this. Now, with the first one, obviously, if you have money in the stock market and you lose a little bit, that hurts, but it's no different than not buying an investment that you should have bought and missing out on the upside on the way. And it might be worth asking yourself, how many times have you missed out on the chance to make some money because you are afraid of losing what you already have? Just something to consider. And I'll leave you with this quote to understanding margin of safety along this entire journey as well. Never forget the 6-foot-tall man who drowned crossing a stream that was only 5 feet deep on average. Capital Returns was written by Edward Chancellor in 2015, and it really focuses on understanding the capital cycle and how that impacts returns, hence the name. Now, this book is a little bit different from the rest because it's not like your standard chapters that you have in a book and a complete story, but instead it's a bunch of excerpts from portfolio managers from 2002 to 2015. So it's almost like getting to see the inside thoughts of portfolio managers during market cycles. Now, the main takeaway is this idea. When capital floods into an industry, potential returns for the future typically drop, and the opposite is true. When capital leaves an industry, the potential returns typically improve, which makes sense if you think about it. If everybody's pouring money into a single investment, at some point it cannot go any higher, and your future returns are dampened because you can't make a ton of money when you're getting in that late. Now, we saw this with Bitcoin, for example, in 2017 when it was reaching 20,000 very, very quickly. A year later, it was down something like 80%. Now, on the other hand, if very few people are interested in a particular industry, that can be an opportunity to get in on the ground floor before the price explodes. So before you go buy an investment, always do your own research, and it might be worth asking yourself or your financial advisor if the industry you're thinking about buying in is already too popular. Poor Charlie's Almanac was written by Peter Kaufman in 2005, and it's basically a collection of speeches and wisdom from Charlie Munger, who is well known for being the right-hand man of Warren Buffett, considered the greatest investor of all time. Now, when I think of Charlie, I think of 3 things that come to mind: inversion, mental models, and bluntness. Munger was famous for always flipping problems on their head so he can find an easier way to get to a solution. For example, instead of trying to find stocks to buy, he would look for investments to not buy. That way, he would avoid all the bad companies, and then all that would be left in his list is good companies to invest in. Pretty simple. He was also a massive proponent of continuous learning and taking lessons from every area of life like psychology, economics, physics, or history, doesn't matter. He used what he learned from these various disciplines to create mental models that helped frame the way that he saw the world and therefore decision making. And lastly, he never sugarcoated his thoughts, which is one of the reasons why I love him personally, because he always got straight to the point and he never felt the need to be apologetic for his authenticity. And a perfect example of this is the opening quote from his book, "Acquire worldly wisdom and adjust your behavior accordingly accordingly. If your new behavior gives you a little temporary unpopularity with your peer group, then to hell with them. What a legend. Speaking of Warren Buffett, the next one is Warren Buffett and the Interpretation of Financial Statements, written by Mary Buffett and David Clark in 2008. What the authors did was create a very tactical guide on how you can read through financial statements just like Warren Buffett. Now, financial statements can be super daunting if you've never looked at them before and you don't understand how the numbers that you're seeing affect the operations of a company. But if you do understand it, you can get a very good idea of what's going on. And the biggest takeaway that I got is in the balance sheet. So if you look for something called shareholders' equity, if that is growing, this is the most important metric on the balance sheet according to Warren Buffett, because it allows an investor to calculate the return on shareholders' equity, which basically tells you if the company has a good long-term competitive advantage or not. And I love this quote here: high returns on shareholders' equity means come play. Low return on shareholders' equity means stay away. The Joys of Compounding was written by Gautam Baid in 2019, and it is one of my favorite investing books of all time. He's actually one of my favorite investors of all time after reading this book. It's basically broken up into 3 different themes. 1 is your perspective on money and investing. 2 is a very tactical guide on picking stocks and portfolio management. And then 3 talks about decision-making frameworks. And I'll break down a piece from each of those 3 categories because, again, this one's my favorite. First off, we need to keep a long-term perspective on markets. Gautam Baid shows research from JP Morgan that since 1950, the US stock market has never had a rolling 20-year period of negative returns. In other words, if you bought the S&P 500 index at any point from 1950 until now and you held it for 20 years, you would make money. Number 2 is to value companies before buying them. One of Gautam Baid's favorite investors is also one of mine, Charlie Munger, which we just talked about. And Munger gave a talk in 1996 essentially outlining the framing of how he uses inversion thinking. Remember, that's how he flips problems upside down so they're easier to solve. One of the ways you can apply this to valuing a company is instead of using what's called a DCF, a discounted cash flow model, you can use a reverse discounted cash flow model. What this does is it gives you a rough estimate on the percentage return that you would need to make in order to justify buying a stock at a certain price. If you run this model and the return is lower than, let's say a sovereign bond, which for the US, it's a US Treasury bond, then it would be irrational to buy that stock. And number 3 is don't time the market. Now, greed and fear will make you do very dumb things as an investor, and it's going to leave you broke at the end of the cycle. This graph on page 347 pretty much sums up the entire idea. When we get greedy, it's usually because we've seen the stock market rising and we want to buy before we miss out on all the action because we see everyone else around us getting rich. This usually happens right before a crash. Then when crashes look like they're only going to get worse and keep going down, we sell because we're scared. This cycle continues over and over again, and it's a perfect argument about why you should not try to time the market. Gautam Baid's second book is called The Making of a Value Investor, and he wrote this in 2024. And it's essentially his diary on what he was thinking during the 2018 to 2020 Indian bear market. And the main lesson for this one is to always stick to your principles and do not get caught up in the short-term mania of markets. One of my favorite things he did in this book is that he kept a log of all of the newspaper articles during that time and saw how negative the sentiment actually was. Seeing this from an outside perspective after he's already gone through it has helped him become a more prudent and safe investor, focusing more on caution and long-term value versus chasing whatever's the hot stock right now. So here's a great quote from the book that I think applies to us today. People tend to underestimate low probability events when they haven't occurred recently, and they overestimate them when they have. Anything can happen at any time in financial markets. More Than You Know was written by Michael Mauboussin in 2006, and I can't even begin to tell you how much information this dude packed into this book. So I'll keep it simple with one quote that I took from it that I think is incredibly powerful. Probabilities alone are insufficient when payoffs are skewed. In plain English, this means that a few really big moves in the stock market will outweigh and be more impactful than a bunch of small moves. This is how the stock market really works. You have hundreds of days every year where pretty much nothing happens, it just chops up and down. Then all of a sudden you have a couple days where it jumps 15%. And we just saw this in April 2025, where within just a few days, the market dropped over 10%. The interesting part is we view many things as normal distributions, but that's not exactly how markets work. They look a little more like this, with a big peak in the middle representing typical days, and then longer tails on the left and right, proving that bigger than expected moves, aka skewed payoff, occur. Now, I don't know where this quote came from, but I absolutely love it. There are decades when nothing happens. Then there are weeks where decades happen. And I think this is another very clear lesson of trying not to time the market at the exact bottom or at the exact top. Because while you do that, you can miss out on the few days that pretty much make up the entire gain for the year, and you're stuck left behind. Narrative Economics was written by Robert Shiller in 2019, and it's basically a collection of Shiller's thoughts on how stories and narratives actually impact and shape economic outcomes. Now, one really fascinating lesson from this book is how consumers in the Great Depression were the exact opposite from us today. After the crash of 1929, 1929, consumers for quite a while did not care to flaunt their wealth to show how successful they were. In fact, that became socially unacceptable and even offensive during that time. Here's an awesome quote from chapter 11, page 140. In the old boom era, I could buy a jar of bath salts or an extra pair of evening slippers without an uncomfortable consciousness of the poor who lacked the necessities of life. I could always reflect happily on the much publicized day laborers who wore silk shirts and rode to their work in Fords. Now it was different. The Joneses were considered to be callous to human misery if they continued to give big parties and wear fine clothes. So while human behavior repeats in cycles, I think it's useful to know how consumer sentiment can shape entire economies. Reminiscence of a Stock Operator was written in 1923, and it's a story on a legendary trader's rise and fall with some market psychology and speculation along the way. Now, I'll keep this one short because it's a semi-fictional book, but I do appreciate the main idea that self-knowledge and risk management are keys to success in the stock market, which is true in real life even if this is a fiction book. And I love this quote from the book: "It was never my thinking that made the big money for me. It was always my sitting." Practical Speculation was written in 2003, and this is one of the more quirky books on this list, but I think it's really interesting for a couple of reasons. The authors of this book found really interesting anecdotal ways to judge the future of a company using qualitative metrics. Chapter 5 of this book in particular is titled "We Are Number One Usually Means Not Much Longer," and they break down what they call the skyscraper indicator and the stadium indicator. The skyscraper indicator is dedicated to companies that build really tall buildings and then seem to struggle shortly after, because it's a sign of their ego and their really poor spending habits. They used Enron as the shining example, which had a $300 million building in New York, which was later sold to pay off all the people that they had scammed. The stadium indicator is dedicated to companies who buy the naming rights to sports stadiums. Enron was also caught up in this, but my mind went to a much more recent one that I think you might remember, the FTX Arena, which Sam Bankman-Fried bought before he was later convicted in what's probably the biggest fraud in the entire crypto industry. And while these indicators may not have endless research and evidence behind them, it's certainly an interesting phenomenon that keeps happening throughout history. The Little Book That Beats the Market was written by Joel Greenblatt in 2005, and it introduces a very simple formula for buying good companies at a bargain price. Now, he does this with what he refers to as the magic formula, which essentially looks for undervalued companies that are making some profits. So what he recommends is to find a list of companies with a really good earnings yield and return on capital. Basically, earnings yield shows you which companies are cheap, and return on capital shows you which companies are making a lot of money relative to what they spend. Also, the title of this book is not misleading either. It really is a little book that you can read in just an afternoon. But I will say this: there's a lot more to investing than just screening for two metrics, getting a list of companies, and then dumping your savings into that list. But I find this book can be a really good start if you're feeling way too overwhelmed with everything involving the stock market. Triumph of the Optimist was written in 2002 by a couple different people, and it basically looks at 100 years of data for global investment returns and then compares them all. Over the last 100 years, the people who stayed invested in stocks, even through wars, recessions, and crashes, came out far ahead of those who played it safe with cash or bonds. Now, this is the key idea that they start with in chapter 1, where the authors show that despite all the insane turmoil that happened in the 20th century, long-term investors who trusted the market were rewarded the most. Equities performed better than bonds in every single country, while bonds beat bills almost everywhere. This is from chapter 1 on page 6. And the takeaway is that patience pays. Literally. Even though stocks are riskier in the short term, history shows that if you wait long enough, this is the best way to grow your wealth over time, especially for optimistic long-term investors who don't panic during rough times. And wrapping up the investing portion with The Outsiders by William Thorndike from 2012. This is basically a study of 8 CEOs who outperform their peers in terms of capital allocation for their companies. Studying CEOs' behavior, decision-making, personalities, track record is actually one of the main principles when it comes to picking stocks that are successful over the long run. And that's because the CEO is the single most influential person when it comes to how the stock performs and the company. Despite what many people might think, their job is to create value for shareholders. Every CEO in history has done this, from Jeff Bezos at Amazon to Steve Jobs at Apple to Warren Buffett at Berkshire Hathaway. So The Outsiders essentially gives you 8 really in-depth case studies for successful CEOs so that you know what to look out for today when you want to pick stocks. Moving on to mindset, we'll start with The Psychology of Money by Morgan Housel, written in 2020. Now, this is the combination of behavioral personal finance and investing, so I think it's a really good place to start, and it's one of the more popular ones. Chapter 11 discusses the idea of being reasonable over rational, and he uses a non-money example of how it's rational rational to not treat a fever when you're sick because the job of the fever is to kill whatever sickness that you have. However, it's not reasonable for most people to just put up with a high fever because it's painful. Instead, we take some Advil and we call it a day. So that's reasonable because even though the science says that a fever is good, reality says most likely we're going to choose to get rid of it. And I say all this to say that there are many rational, science-based ways to invest that prove that you can outperform the market in one way or another, but those strategies aren't all going to be reasonable for you. They may not fit your personality, and that's why personal finance is personal. It might look different for everybody, and that's okay. It's reasonable, even if it's not rational. The Almanac of Naval Ravikant was written by Eric Jorgensen in 2020, and it is absolutely fantastic. It's basically one big guide to building wealth and happiness based on Naval Ravikant's collective work. And the biggest lesson I learned from this is a very tactical example of how to use leverage when it comes to building wealth. And not leverage in the sense that you should go out and borrow a bunch of money and get into loads of debt. He uses leverage in 3 different ways: capital, people, and products. Capital means to simply raise money if you need to start a large project. People is referring to hiring other people to work for you. So in that sense, you get to leverage other people's time and you get to give them a job. But those two are what Naval refers to as permissioned leverage. And he says, do not waste your life chasing these things. Meaning you have to get permission from somebody to borrow the money that they have. Or if you want to lead, someone needs to follow you. But the third form of leverage is what he calls permissionless leverage, which is products. Specifically, code and media is what he's referring to here. And he says you can create software and media that works for you while you sleep. If you can't code, you can write books or blogs, or you can record podcasts or record videos, which is actually one of the reasons why I started YouTube in the first place after I read about this a couple years ago. And by the way, you can too. There's really nothing stopping you, so maybe consider it. Next is $100 Million Leads by Alex Hormozi, and he wrote this in 2020. This is basically a very tactical guide on the entire process of lead generation. And if I had to sum up all of Hormozi's principles from this book and pretty much everything that he says, it would be one word: volume. My biggest takeaway from this book is how lead generation, essentially getting people to know about and want to buy the thing that you're selling, is simply a numbers game, and he breaks down exactly how you can do it with 4 main principles: paid ads, cold outreach, warm outreach, and content. Pick one of those 4 and do 100 a day for 100 days, and it's gonna be really hard not to find your first customer. Next is Shoe Dog, written by Phil Knight from 2016. Now, Phil Knight is the founder and CEO of Nike, and this whole book is an incredible story of how he started from the very beginning all the way to where he was in 2016, and I promise you, this is worth the read. By far, my biggest takeaway from reading this book is how many times Nike almost went bankrupt and how Phil Knight just kept pushing through every single barrier that he ran into. And he did this for decades, and he never let a single thing stop him from achieving his goal of building up Nike to an incredible company. The resilience and the constant ability to take on more and more risks to grow the brand faster and faster is honestly insane. I would not be able to do it. And after reading this book, I understand why so many companies fail and don't get to the level that Nike has gotten to, because it takes a lot. And it's incredible storytelling. I promise you are not going to get bored reading this book. Highly recommend you check this one out. Following that is a book called Quitter by John Acuff from 2011. And it's essentially a meaningful guide to help you transition from your full-time 9-to-5 job to work that you actually love. Now, I read this book probably a decade ago, and the main lesson has stuck with me ever since. If you want to become an entrepreneur and run your business one day, do not quit your day job. Do not become a quitter, hence the title, because if you just quit with no plan ahead, it's very risky. It's far less risky to keep your 9-to-5 and work on your side hustle in your spare time until it has the potential to become a full hustle. Then you know you're at the correct jumping off point. Following that is the 48 Laws of Power, written by Robert Greene in 1998. And this book is a masterclass at understanding the dynamics of power and influence and how you can go about using them. And I'll be honest, this book can be a bit scary, at least it was to me when I first started reading, because it felt like Robert Greene was convincing me to use all these laws of power on everybody. Now, I understand that was not his intention, but some of them feel inherently selfish and a little bit devious, so I wouldn't recommend everybody to use all of these laws. But what I found incredibly valuable from reading this is simply being aware that they exist. See, if you aren't aware that a certain power law exists, you may not be privy to when somebody's using it on you, and you could potentially end up getting manipulated and twisted. I think it's far too easy to fall victim to these things when people know them and they're able to use them against you. And so I almost took the lessons from this book as a way to be defensive against them, and that way, if I'm in any type of business negotiation, or if somebody at work is trying to climb the corporate ladder as fast as possible without any regard for everybody else, you won't be one of them because you're aware of the tactics that they're using and how to defend against it. Blue Ocean Strategy was written in 2005 by multiple different authors, and it's basically a strategy book focused on how you can create uncontested market space through innovation. Now, the authors describe a blue ocean as a market that nobody has ever touched before. And you could think of this like the internet in the 80s or the iPhone in 2007. These things didn't exist before, and because of that, they became completely integrated with our lives once they were introduced. This is opposite from what they refer to as a red ocean, which is a saturated market that already has way too many players. There's too much blood in the water already. I think of how many local breweries are in my city or how many, light bulbs that you can buy on Amazon. When there are so many sellers in a market already, it's tough to stand out. But the way that you find a blue ocean is by combining multiple ideas together to create something new. The example that comes to mind for me is the comedian Bo Burnham. He doesn't do your typical stand-up comedy like everybody else where he just has a microphone and a blank stage. Instead, what he does is combines comedy, music, and theater to create these funny skits and essentially creates a blue ocean for himself. It helps him stand out as really unique, and you can do this too with whatever you're doing right now. What you can do is combine 2 or 3 interests that you already have, and you can see what emerges as a result. I actually saw a pretty interesting example of this the other day on YouTube where I was searching for finance channels, and I found a channel that was playing Call of Duty while also talking about his personal finances the entire time. So it was like 20 or 30-minute long videos where he's just playing Call of Duty. That's all you see the entire video, and he's doing a voiceover talking about personal finance, investing, and economics. That's technically a blue ocean. The 4-Hour Workweek was written by Tim Ferriss in 2007, and it's an amazing account and guide on how you can escape your 9-to-5 and live the life of your dreams. Now, Tim Ferriss is an incredibly successful individual and a really interesting dude, and he pretty much did this for himself way back in the day, and now he's living proof of what he talks about in this book. And I view this book as kind of the kicking off point for him becoming famous because his main idea is to not waste your life waiting until you're 65 to actually enjoy it, but instead try to create a life that you enjoy now so you're not just waiting for the weekend or waiting until you're, again, 65. And the key point that I really love from this book is that time and freedom is what makes somebody rich, not necessarily how much stuff they have. Rich Dad Poor Dad from Robert Kiyosaki in 1997 is probably one of the most popular on this list, but honestly, it's not my favorite. The only reason I have it in here is because I think one page in particular is actually helpful. So if you have this book, page 88 illustrates what a cash flow model looks like for a poor, a middle class, and a rich person. So what he describes is poor people usually make money and then they spend it and that's it. Middle class people go from a job to an income to liabilities and then expenses and then their money goes out. But the thing that rich people do is different. Rich people buy assets, which builds more income, which means they can buy more assets, and it creates this endless cycle. And if you understand this concept, then you'll seek to spend money on things that actually create more money for you, not just spending it on whatever you see on Amazon or at the store. And this book actually helped me shift my view from consumer to investor when I first read it years ago. The rest of it sounds like a bunch of made up stories from Kiyosaki, but again, I'm kind of biased because I don't really like the guy, so maybe you'll get something else out from it if you read it. Economics in 100 Quotes was written by Dan Smith in 2018, and it's basically a compilation of quotes aiming at breaking down economic concepts into simple bite-sized chunks. The one that I love in particular is this: there is no calamity greater than lavish desires, there is no greater guilt than discontentment, and there is no greater disaster than greed. Most of us don't like being frugal. We don't like being cheap. We hate saying no to ourselves when we want something. So the goal to achieving frugality is to become free of the slavery to stuff. And this quote dates all the way back to 6th century BC from Taoism. They understood that when you become free of desire, you become the richest person in the world because you cannot be bought. You simply become content with what you have. All right, the last 2 books on this list fall in the category of big picture, kind of getting a broad view and understanding of the world. The first one is called Collapse by Jared Diamond from 2000. In the book, he explores historical societies to understand the environmental and societal factors that play into whether they collapse or survive. And what he found was 5 main key factors in this entire theme: environmental damage, climate damage, hostile neighbors, trade disruptions, sound familiar, and society's own responses. He draws on case studies from ancient Mayan times all the way to modern day Rwanda to show that choices, not just circumstances, determine survival. So here's the key insight: societies collapse when they fail to adapt, ignore warning signs, or prioritize short-term comfort over long-term sustainability. And this leads me right into the last book, which is a perfect way to wrap up this entire thing, which is Principles for Dealing with Changing World Order. And this book was written by Ray Dalio in 2021. What Ray Dalio looks at is basically the global economic and political cycles and offers insights into how empires rise and fall and how you can position yourself during these times of disruption. No system of government, no economic system, no currency, and no empire lasts forever. Yet almost everyone is surprised and ruined when they fail. This is from chapter 1 titled The Big Cycle in a Tiny Nutshell. Now this quote, along with many of the concepts that Ray Dalio talks about in this book, I think are incredibly important for us to know about today, especially for us in the US. I certainly have no idea when the US will no longer be the global superpower that it's been for the past 130 years, but I think it's important that we know that this is not going to last forever. And in practical terms, this reminds me to stay a little bit open-minded with my investments in particular and add some global index funds to my portfolio, maybe even an ex-US fund. That way I don't have all my eggs in one biased stock market basket just because I live here. Now, some honorable mentions that I have on my reading list are Your Money or Your Life, Die with Zero, The Richest Man in Babylon, The Millionaire Next Door, Think and Grow Rich, Common Stocks, and Uncommon Profits. This was a long one. Thank you so much for watching. If you want to see me do a full deep dive, a full breakdown of any of these books that I talked about today, just mention the title in the comments below. Otherwise, hit subscribe and then check out this video next to see how to apply some of the lessons you learned today to transform your finances in 6 months. Peace.